this woman had said to the group, she goes, "Oh, my boyfriend's going to buy me a BMW, a new Beamer." Obviously was before I started making all these rookie mistakes. I mean, look at my hair today, certainly has changed. It took a toll on me, as you can see. And even now, I remember thinking, there's something wrong here. Like there's something risky here. And I have a very painful story. We got pennies on the dollar. I recently posted a video on 26 rookie mistakes that are made by investors of all experiences, not just rookies. The goal was to point out some of the most common mistakes to help you avoid them. Well, one of our viewers, Kevin, sent off a comment, and Kevin said, "Can you make a video of these mistakes and how you do not make them in your own investing? It would be helpful to see how you have overcome these mistakes with your own investing instead of saying these things without presenting examples of investing with your own actual skin in your game." Kudos to you, Kevin, for not just saying, "Hey, yeah, easy for you to say what the mistakes are. Let's see what mistakes you've made and how you've learned from your experiences." And so in this video today, I'm not going to cover off all 26, but I am going to peel off 4 of these mistakes that I've identified that I've learned the hard way. And when I say hard way, I mean the costly way. Yes, I have made money. I have lost money. I'm hoping that if I share some of my learning experiences, let's call them some of my rookie mistakes with you, it will help you further your investment game as well. For those of you who are new to this channel, my name is Mark, and on the channel, we make videos for fellow Canadians with the goal of helping them improve their investment and financial lives. So welcome to the channel. Nice to have you along. The first rookie mistake that I'm going to share with you that I've made personally is goes back about goes back a long time. It goes back to the mid 80s. So I would have been in my mid 20s, I guess, at the time. And it was sort of a classic buying penny stocks. When I was working in my mid 20s, I had a career in the airline industry. And yes, there's a quick shot of me here. If you can believe it, look at all that brown hair. Well, that obviously was before I started making all these rookie mistakes. I mean, look at my hair today, certainly has changed. It took a toll on me, as you can see. I was working, as I say, in the airline industry. And one of the things that I guess in a lot of industries people do is people chat. And it happened to be a counterpart of ours who worked for another airline was dating a fellow who worked back. For those of you who are old enough to remember, and if you're from the Vancouver area, you'll remember the Howe Street Gang, the Murray Pesums of the world. And there's a whole cadre of these guys who were, they made $1 million, lose $1 million, made $1 million, lose $1 million. And so this person, this counterpart in the business, was dating a fellow, a friend of Murray's, I believe, and they had some information that they would share with the other co-workers as to some hot tips, stocks that you might want to buy. And I wasn't too big on buying the penny stocks at the time. However, I do remember one incident in particular that has stuck with me forever. And it is a classic pump and dump scheme, as is so often so prevalent in this penny stock area. But what happened in this case was this woman had said to the group, she goes, "Oh, my boyfriend's going to buy me a BMW, a new Beamer." And we all thought, "Oh, that's nice." And she said, she gave us the name of a ticker. No idea what it was. It was a long time ago. I've totally forgot what it was. But she said, follow this ticker. It's trading at, I'm going to make up a number right now because I don't remember the number, but it's trading at 20 cents right now. Next week, it's going to go up to 40. It's going to double. I remember that context. And then he's going to buy me a car, and then it's going to go back down. And I watched this with great interest, as we all did. And sure enough, sure as shooting, the stock, whatever pennies it was trading at, it literally doubled the following week. And then a few days after that, it was right back to where it was. And it taught me how easy it is for these insiders to manipulate the price of penny stocks. And we like I say, we talk about pump and dump, and this is a classic example. And if you're not one of those insiders, yes, you can make a ton of money if you buy a 2-cent stock and it goes to 4 cents. But the risk that you take involving in these is just too stressful. For me, I found out even as a younger investor that the whole concept of penny stock investing was just too expensive. Rookie mistake number 1 is going out just buying penny stocks without doing any research on them because it's the next greatest thing, and that can really come to haunt you if you're not careful. The second rookie mistake that I personally have made, which is number 8 on that list of 26 I referred to earlier, is not understanding how an investment works. In the mid-2000s, I made an investment into what was called the Hedge Capital Preservation Fund. And think of the context at the time. And we'd come out of the tech crash. So the tech crash, 2000, 2001, 2002, were sort of getting back to normal. The markets had done quite well. And the markets had climbed to a point where I was getting a little bit worried that the markets might be overheated. And this investment, the Pro Hedge Capital Preservation Fund, in its information that they sent out, the marketing information, they specified the fund is designed to preserve capital through low-risk performance derived from a diversified basket of arbitrage-style hedge fund investments uncorrelated to stock or bond markets. And at the time, hedge funds were really the exclusive domain of the ultra wealthy. And yet this type of a new investment came along where it allowed the average person to participate in hedging as well. And so this sounded like a really good idea to me. But as we got closer, as we went along, when the markets, again, going through the recoveries, I did start to get a little bit of worried. And what really caused me some concern was when I communicated with ProHedge, their office was in one of the Ontario towns, Mississauga, maybe Burlington, one of those towns. When I was trying to communicate with them, the answers, the explanations to how the investments were doing were quite vague. In fact, they were unsettlingly vague, to the point where I decided, I don't have confidence in this company or in this investment anymore, so I need to take my money out of the investment. Well, this is where I learned my lesson real hard, because had I understood how the investment works, I would have known that you can't just redeem the investments like you can go out and sell shares of Royal Bank anytime you want. I was aware that there was a 30-day limit, a 30-day notice that you had to give. But what I didn't read was the fine print that said, essentially, if the company, at their discretion, decides that it would be in the shareholders' best interests not to redeem units, they could suspend those redemptions. And I learned when I placed that redemption order and it got queued up and I was following up and going, why isn't this trading? Why isn't this trading? I learned that they had, in fact, suspended the redemptions. And I'll make this long story short. This was a multi-year process of getting some return on my money back. I didn't get it all back. I got nothing initially. And of course, what led up to this was the great financial crisis. And as we're going through that, the company basically said, the assets that we had, even though this fund was designed to protect on the downside, to preserve your capital, they failed mightily. And so as they unwound this investment, we got pennies on the dollar that came out after that. So that was a pretty expensive lesson for me to learn, is not understanding the intricacies. And this comes down, and not a lot of people want to read the prospectus on an investment that goes out. I did another video fairly recently on another, not a comparable directly, but on split share corporations, which is another type of investments that a lot of people don't understand. If that's something that you own or you're considering owning, maybe considering checking out this video that talks specifically about the ins and outs of those funds, because again, the yields look really attractive on them. I'm not saying they're not appropriate for you, but a lot of people buy them without understanding, what they're even buying in the first place. So I got burned on that back in the day, and I'm hoping that that's not something that you'll repeat yourself. So let's move on now to the third lesson, the third rookie mistake that I personally made that hopefully we won't repeat again. On the list of 26, number 22 is false buy signals. And specifically, I spoke about things like price to earnings ratios, relative strength index indicators, things that you might watch that would indicate whether a company is overvalued or undervalued. And so the concept was, if just because a company has a low PE ratio, or just because it's trading at a RSI under 30, it doesn't mean you run out and invest in it. You always have to do your due diligence, do your homework first. That can be a first signal, but you don't go out and buy just because of that. Well, my big mistake, one of the biggest mistakes I've ever made financially, was kind of the flip of that. It wasn't a false buy signal. It was a false sell signal. And in this case, there was a company that I was an investor in, and it was trading at a climbing multiple, a PE multiple that just kept going up and up and up. And it got to the point where I couldn't take it anymore. All my training said that there's danger here. So I sold out of the position. And for those of you who aren't jumping the gun, taking one step ahead, of course, that company was Amazon. And we all know what's happened to Amazon in the interim since then. If we look at this chart, this was back in the around the 2013 area, and the company had gone, I remember specifically, it had gone over a price to earnings multiple of 200, and I just thought that's too rich for my blood, so I exited out of the position. Now, of course, when we overlay that with the timing of the PE going over 200, and the price of the share price going up from then is, we can see it's been basically an uphill ride since that time. What I failed to do, my rookie mistake, was to not look beyond that multiple. And so with that high 200 PE, my intuition was I've got to exit this position, which I did. But there's good reasons, and there can be good reasons why a company might be trading at a multiple that normally wouldn't look good, but it might be. And in this case, I mean, clearly, when you think of Amazon, they had no real competition at the time. People would argue even today they don't. Bezos's stated goal was to take all of the earnings and pump them back into the company, so that would artificially inflate that price to earnings ratio. So there were good reasons, and if I had done my proper work, if I hadn't just reacted to that multiple, I would have perhaps seen that, had comfort in it, and held on to the position. And I do own Amazon again today, but I was out of it for a period of time until I got to know the company a little bit better and had more confidence in it. So yeah, that was a rookie mistake that I made, was to, in this case, I fell for a false sell signal. I didn't do enough work behind the scenes to confirm that what I was seeing was accurate. The fourth rookie mistake that I made, and this was a big one, and it cost me a lot of money, and it lives with me to this day, was on the list that I put up previously, number 23, not taking profits. And I have a very painful story. There's a company that's based out of Burnaby, BC called Ballard Power, and a lot of people may have heard of that, but certainly back in the 90s, this was the darling of the industry, of the tech industry. And during those times, the market, everything was going up, and Ballard had this fuel cell that they had developed, and the goal was to put fuel cells in all the vehicles on the planet, basically. And I remember the concept that by 2010, which seemed like a long time, it was more than a decade out when I started buying these shares, that the world fleet would be converted to fuel cells, and I liked the story, and I took what I would say a reasonable position in Ballard Power, and over I think 3 different tranches I bought into the company from initially below $10 a share, 7 or 8ish in that range, and the most recent, the last purchase I made was up in the $15 range. Well, when the company took off, I enjoyed the ride. As you can see from this chart here, the share price basically went straight up, and it topped out at around $200 a share, and I owned 1,000 shares at the time. So I had, as a younger investor, even today, I mean, that's a big chunk of money that I had that I could have cashed out. And even now, I remember thinking, there's something wrong here. Like, there's something risky here. Should I put a stop loss order in, or should I just trim my position? And I guess, as you probably figured out, because in the day, everything was going up, everything was going to continue to go up, and I did get caught up in that. And so no, I didn't sell any of the position, and I wrote it all the way back down, and I vowed at the time that I would never, ever sell those shares of Ballard Power as worthless or as lowest value as they became. And I've lived true to that. To this day, I still own shares of Ballard Power, and they're in my portfolio to remind me of this. And so, today it forms a very small portion of my investments overall. Now, I did actually learn from that experience, and I'll show you why. In February of 2021, I said I would own these shares forever, and I do live to that, but the share price of Ballard had gone up quite a bit leading up to the middle or the early part of 2021. And in February of 2021, I actually trimmed my position. I maintained 500 shares, but I did trim my position. And as you can see from the chart, it turns out that my lesson was good, because I did actually end up saving a bunch of money. I didn't make a bunch of money on them, but I did save a bunch of money by trimming that position. So I have learned through some of the rookie mistakes I've made. My question to you, what is the worst rookie mistake that you've ever made? Doesn't matter whether you're a beginner, doesn't matter whether you're a seasoned veteran, we all make them. I would love to hear your stories. Please do share those with us. I thank you very much for watching the video, and I look forward to seeing you in the next video.